Firstly, my company's name is Signature America Wealth Management. And the topic, of course, is the potential tax storm. And, uh, and this is a copy of the announcement that you had received. And, uh, and starting at 6 o'clock. So we'll move further on. Okay, whoops. So you may say, well, okay, Paul, what makes you so good in giving you advice on tax structures, estate planning, and income taxes changes that are coming up? Well, I've been in the business for about 30 years, and some of the people I have worked with over past 30 years have had great uh, reputation in estate planning and financial planning. And these are the people I learned a lot. The tricks of the trade from them, different planning techniques, and each one has his own specialty, his own technique. They may all actually be in estate planning, and actually all of them are in estate planning directly or indirectly. Some of the names that you're seeing here, they are on my panel, and whenever I cannot answer a question on estate planning or if it's a complex situation, these are the people I reach out to. Bob Keebler, for example, if you were to put his name in Google search, you will see tens of thousands of searches that'll pop up. He's connected with universities and big institutions. Some of the wealthiest people in the country actually consult with him. And in fact, Congress and senators, whenever they are implementing a new potential change in the tax laws, they consult him about the impact it might have on the society in general, how much it'll cost in revenues, and how much deficit it may result after all you take and give and take in terms of new revenue that will be new taxes that will be generated, and in the end, how much it'll cost the government, or would the government be in a surplus of any kind with the tax changes? Then same thing about the gentleman that you see next to him, Mark Harazzo, Paul Hood. Paul Hood is a very celebrated person in terms of estate planning and business succession planning. And on the lower right corner, you will see the gentleman named Mark Schenkman, some of the wealthiest people he has actually worked with. And the gentleman on the right, Jonathan Blattmacher, same thing. Some of the very well known personalities in showbiz and politics, he has done their estate planning. And I'm so fortunate to have them on my panel. So if you ever have a question, these are people that I reach out to when they're way over my head. So let's go to the next slide. So what are the topics we're going to be talking about? The topics we're going to be talking about would be the potential tax changes that are coming up under Mr. Biden's proposal, and the impact that's going to have on your tax rates. And then the question is, if the rates are going up, should you convert your taxes, your IRA to Roth, or 401k to Roth? Then the next topic is, what is an IRS loan? Unfortunately, almost all of us are carrying IRS loan, huge amount of loans for some people. Then, as you know, yeah, I'm sure you've heard of it, even though uh, it's something recent that's come about, that your capital gains which are capped at 20% may be going back to shifting to the full regular income tax rates for those people who are going to have lots of capital gains. So if you are thinking of selling a property which is worth millions and you have a lot of capital gains in there, or business that you think you may be selling next year, following year, well, you may want to reconsider that, because the capital gains on those kind of properties and businesses where the gains are going to be in multi-million dollars, you may want to sell them sooner than later, because later on you may be paying taxes at the rate of 39% plus, which is going to be the regular income tax rate, by the way. So also, you may be saying, what to do with the highly appreciated stocks, business, or rental real estate? If you sell it, what are you going to do with the capital gains that you are going to have? You do not want to pay the taxes even at 20% rate today. Well, when we say 20%, actually it's a misnomer. In California, it's not 20%. By the time you add the state tax of about 13% in the higher income tax brackets plus Medicare tax, you're looking at about 37% in taxes, even on capital gains in California. And can you imagine then when the tax rates, federal tax rates go to 39% plus, you'll be looking at regular taxes, your capital gains taxes, which are going to be the same as regular taxes, to the tune of about 53 to 54%. So if you sell those properties today, and if you're thinking of selling, by the way, you should not sell simply because the taxes are a consideration. If your rental properties are generating big income, by all means continue on that path. They keep living off of that income. But if you're thinking of selling, might as well do it now. So what are you going to do with the capital gains that you do realize? Well, there are some rescue plans for that too. And if time allows, I'll discuss those and so that you do not have to pay taxes on those capital gains. But for now, we'll just continue moving forward. And let's see. The next thing we're going to talk about finally are the changes that are in the offering on your estate plans. As you know, today you can actually give away but $11.5 million, actually $11.8 million per person in America. So let's suppose you have been very, very successful in your life and you have accumulated with 30, 40, $50 million in assets. And uh, so 30, 40, $50 million in assets you have, or $100 million or $200 million in assets you have, and you know you will not need all this money uh, while you're alive. So you want to pass on as much as possible to your children. Okay, you want to pass it on to children, but you don't want to give them away today. So you put them in some kind of what we call irrevocable trust or dynasty trust, but someday they had to pay taxes. Someday when you pass on, they will have to pay taxes. Under current laws, they say, okay, I know that taxes have to be paid, but the law allows you to give away up to first $11.8 million for husband and $11.8 million for wife. So close to $24 million you can give away without any inheritance taxes. Well, that cap is coming down. It's going. The proposal is to bring it down to $3.5 million per person. So that's going to have a big impact on people who have already initiated the plans to pass on wealth to children, and and at this point, either you need to accelerate those plans or do it more intelligently. And I'll talk to you about something we call SLAT, Spousal Limited Access Trust. So in that, where you can give away and still maintain control. We'll come to that too. But let's move forward. Now, one of the things I want to let you know is I want to actually recite an incident that took place about a week ago. I was invited to a very nice restaurant off of Newport Beach. It was somebody's daughter's graduation from medical school. And so money was no consideration for the father that day because it was a big, big celebration of a big event for him. And the restaurant was right at the beach, right at the ocean. At my table were a couple of businessmen and a very successful doctor, and a couple of them were actually programmers and software engineers, and a few of them were nurses and medical students. And as you know, medical students they are barely struggling, barely able to pay bills, and they're struggling in their lives. And programmers and software engineers, yeah, they make a half a decent living, so they are able to manage their family expenses. They are not what we call wealthy, where they have a lot of wealth. They cannot relate to people with a lot of wealth. So now, when the waitress came to our table, and out of curiosity, we asked them, "Hey, what are those beautiful big yachts? Who do they belong to?" Well, my gut feeling was that she's going to say, "I don't know, sir, who they belong to. They've been here. They're just somebody parks them here and goes away." No, she knew the history of those people. She says, "Sir, this yacht standing there belongs to a businessman from Pasadena. He just bought it for $35 million. Previously, he had a $10 million yacht. It was too small, so he bought a new one. The next yacht, she says, that belongs to the dentist who invented Invisalign. So that was worth about $20 million. And now, as she's mentioning to us, turns out uh, that people who are let's say students and software programmers, they could not relate to any of that stuff. To them, it's a totally different world. People who buy those kind of yachts, they have spare money, and so they they said ooh and ah, but beyond that, they could not connect with any of the information that we gathered about those yachts. But the businessman and doctor, two businessmen and doctor, they started talking about yachts, and businessman says, yeah, maybe I should look into a yacht for myself too. The point being, here there was such a disconnect between the reality for some people and where this current situation is. I want to make sure that my webinar here actually is good for everyone. Sure, certain topics would be applicable to only a few people, but I want to make sure that it applies to everybody, at least most of the body of the webinar. All right, so we'll move forward. Oops. So before we go any further, I want to give you a disclaimer that we are not giving you a tax advice or legal advice. We are just giving you general information. If something applies to your personal situation, sure, you take the ideas and suggestions from here and then discuss them with your accountant and attorney. All right, so today's agenda is where are we right now and how did we get here? Where could you go from here? And could your taxes be on the way up? I should say, do you really know that the taxes are going to go high up? Well, they may be going, as I've heard the figures of as much as 65% federal taxes for people in higher tax brackets. All right, let me move this. Something's blocking my screen, so I'm going to move that out of the way. And so next topic and next thing we're going to talk about is what can you really do to help protect yourself from the increase in taxes that are coming your way. Oops. Okay. So here are the things you can do. So here's a question I have for you. How many people believe that their taxes will be lower in retirement? I'm going to pop up. Let's see if I have poll question for that. And go ahead, tell me in your during retirement if your taxes will be higher or lower or higher by a lot. Go ahead and answer this poll. It's going to be up for 20 seconds. All right. Thank you very much for participating. Go ahead. I think some more people still clicking. Five more seconds. Okay, good. So most of the people believe the tax rates are going to go up, and some people believe they're going to go up by a lot. And actually, in retirement, a lot of people have actually a wrong belief that taxes are indeed going to be lower in retirement. Well, that may have applied to your parents who lived on limited income, but the way people are now actually working so hard and investing money, and with also tax rates going up, so income's up, tax rates up. Most likely, people in retirement years will indeed have more to pay in taxes. You should look at your own portfolio, the way either you are in the process of building up your 401k and IRA, or if you are near retirement or have retired, when you see in your portfolio multi-million dollars, say, holy moly, I did not expect so much money. And now IRS knows it too, Congress knows it too, how much money you're sitting on. So their eyes are on that money, and they are going to want a big share of that. And so your taxes indeed will be going up. So now, in very few cases, taxes may not go up because you are on fixed budget and you are going to have a limited pension plan. But in most cases, taxes will be going up. Okay. Now, how many people believe that when you look at your 401k or IRA, that's really all your money? You see, I have seen people look at their portfolio of 401k and IRA and say, wow, I have $4 million in my IRA or pension plan. When I use the word IRA, I want you to understand that includes your pension plan, 401k, or other similar vehicles. So when people look at the IRA, may have $1 million or $10 million or $8 million, and people think, wow, I have $8 million. No, 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 it's not yours. It's just like a home. If you have big mortgage on the home, it's not all yours. Part of it belongs to the bank. Same thing with an IRA that you perhaps have $5 million at retirement, or let's talk about the average person who is still in the process of accumulating their money in 401k. So if they have $1 million, $2 million, it's not really all yours. Part of that belongs to IRS, and IRS has said, hey, go ahead, keep the money that you're going to pay in taxes. Go ahead, keep it, make it, make it grow as much as you want, and you give us money, give us the loan back at some later date. Now that's where I'll tell you why IRS loan is actually much scarier than borrowing from the bank. And we'll talk about that in a minute. So question number one, where are we right now and how did we get here? Well, firstly, I want you to know that the deficit has been mounting in America anyway, but suddenly it accelerated last year on March 27th, 2020, when President Trump, to deal with the COVID situation, actually signed a bill for $2.2 trillion to help out the country. And so that added a big sudden jump to the loss of our to the loss of our budget. Now, so move forward now to month of December. In the month of December, right before the clock ticked of December 31, President Trump again raised another $900 billion to help out the public, because the businesses were still suffering, public needed help, and there was a lot of unemployment. So $900 billion with the help of Congress, they got approval, and so that added to the budget, to the deficit. Then come along month of January, as you know, that President Biden has requested $1.9 trillion on top of the previous deficits, the previous monies that have been actually raised for the COVID. So all of that added up is really increasing our deficit at a very accelerated pace. If you remember, right before President Trump came into power, our national budget, actually the amount of debt country carried was $18 trillion. Today, is over $28 trillion. In this picture that you're seeing, it was $27,864,000,000,000 a few weeks ago. And it's already skyrocketed to a much higher number. It's about $28.5 trillion now. So we are actually adding to our budget deficit at a very, very fast pace. So by the way, if you look on the top right, says with that kind of budget, that turns out to be equal to $84,000 per person of debt for every American. But not every American is paying taxes. There are children and older people and indigent people or people who just don't have enough money. So when you actually look at the figure again on the top right, just to the right of the total trade, the total national debt, you'll see the debt per taxpayer is $222,000. Okay? So if you're in higher income tax bracket, the deficit, the portion of deficit that falls on your shoulders is even higher than that. So question number two, where do we go from here? Will your taxes be on the way up? Yeah, you already mentioned to me, yes, they will. So now we talked about taxes going up, but guess what? The government is thinking of raising taxes in some other ways too, without raising taxes. And one of those ways is, you see over here, Elizabeth Warren saying we should increase the budget for IRS, triple the budget from about $11 billion to $31.5 billion to monitor the tax returns of mostly higher income bracket. We know that when they say higher income bracket, they'll put the pressure on everybody that there'll be more IRS officers and everybody will be under the microscope. So the the end result will be there'll be a lot more audits, and it's possible that government is going to be raising the estimation is that they might raise as much as $1 trillion, $1 trillion over the next 5 years just from these audits. So now what does Mr. Biden's 1.9 trillion plan covers? Well, firstly, as you know, everybody got the $1,400 in checks. Actually, they will be getting $1,400 in checks, and so a lot of those other previous checks have already been mailed out by under Mr. Trump's plan. So unemployment benefits, the $1.9 trillion will cover unemployment benefits, and also the minimum wage will be increased to $15 per hour. That's one of the proposals in there. And let's see, then of course, there's going to be budget for COVID testing, vaccine programs, aid to local governments, to schools, businesses, small businesses, and the child tax credit. So here's how it breaks down. As the budget deficit increases, so they are going to now find ways to raise the taxes. So how are they going to do that? Well, right now, as you know, we pay Medicare tax and FICA tax only on the first $142,000 of income. Any income that you earn over that amount, you do not pay that tax. And here's a side note. Government actually raises more taxes from Social Security and Medicare tax than all other income taxes. People don't know, most of the people don't know that. The reason being that everybody pays into Social Security and Medicare, while there are not that many people compared to the overall number of people who are paying into Medicare and Social Security. The number of people paying into income taxes in higher brackets, well, okay, they have incomes, but they peter out after $142,000. Nothing's being raised beyond that. And if somebody's income is, let's say, $60,000, they're not paying as much in income taxes as much as they're paying in Medicare and Social Security tax. Even a person earning $80,000 to $100,000, if they're married, the income tax they're paying is much smaller than the Medicare and Social Security tax they're paying. That's why the government ends up getting a lot more from Social Security and Medicare taxes. Okay, so now what they are proposing is that instead of limiting the Social Security tax cap just at $142,000, they want to, while they will not raise that $142,000 limit very much, they may go to 145, but they're going to jump over to people whose income is over 400,000. So if you're earning $400,000 or more, well, you move back into paying the Social Security and Medicare tax, which, as you know today, is a little bit over 15%, which means 12.4% Social Security and about 3% Medicare tax. Also, they're saying that under the new tax proposal, they are saying we are not going to limit the taxes currently at about 34%. It's going to go to as much as 39.6%. And I know, by the way, today the cap is 37% for really high earners. So that's going to be raised to 39.6%. And that 39.6% will jump up, will creep in at, at a much lower cap of income bracket than it was previously under the current law. Actually, under current law, you had to you had to be in a much higher tax bracket to have to pay 37%. But under the new law, you'll be paying 39.6% at lower income. Now, also the capital gains that we talked about, they are going to be, you're going to be paying higher taxes on those. And then are the itemized deductions. Right now, we have clients who have, let's say, income of 600,000. They may be writing off $200,000 or so in itemized deductions, or 100,000, 50, whatever amount it is, 100, $200,000, because they got a lot of investments, or perhaps some business expenses they incurred. Business may or may not have been successful, so they're able to write a portion of that out as itemized deductions. So in any case, the government is saying from going forward, they are going to actually even tax the itemized deductions up to the rate of 28%. So they would not be all fully tax deductible. And the item described below that, next line, is about 3% piece limitation. Most people may not even know what that is. Actually, a lot of people do not even know it exists. You may not know that if you're a high earner, the itemized deduction that you take for, say, when you have home deduction and this deduction, that deduction, you may think you just took a write off of, let's say, last year you might have taken a tax deduction of itemized deduction of, let's say, $50,000. But if your income is very high, you may not know that those itemized deductions are being recaptured at high tax bracket, and they happen so silently and quietly that you don't even know itemized deductions have been washed out. So that's called peace. So it had been actually peace had been suspended for a while. Now they are saying they're going to reintroduce peace. And then, of course, is the new 100 section 199A deduction. As you know, people who are self-employed or have LLC or have S corporation, if their income has been, say, below $326,000, they do not pay income taxes on the full 326,000. They are able to write off immediately off the top 20% of the income, and only on the remaining portion they pay the income taxes. So they are going to be tinkering around with that too, and so it's going to be more limited. All right, and let's see. So to reiterate, 39.6% capital gains rates will be applicable to gains of over $1 million. And the next thing that's going to be impacting wealthy people, or actually we should not even say wealthy people, applies to pretty much anybody, anyone. It used to be that if you had appreciated property, whether it was a home, even today, I should say, I should not use the word it used to be. Living in the world where I'm living, we know that these tax changes are realities coming any day. So, but perhaps you have not heard that so often as we do, so I should not be using the past tense. So under current laws, there's a step-up basis, step-up rule, that if you purchase a property, and let's say it was worth $300,000, and you kept the property in your name, and let's say it was an apartment complex, and it has escalated in the last 30 years to $8 million, and you pass it on to your children, they inherit it. Guess what? All the capital gains under current laws are wiped out. They do not have to pay income tax on the gains. So they are saying, well, not so anymore. That if the gain is a step, if the property gain is significant over $1 million, when we say significant in the eyes of law today, anything over $1 million is significant. So Any gain over $1 million will not have the step-up basis applied to it. So first $1 million, they only pay the income tax earnings that may be building inside the property they inherited, but no capital gains taxes. But if the property that they inherited from you is worth, let's say, $5 million, then they'll pay capital gains on $4 million if there's a gain of five. Okay, so now here are some other proposals which actually are beneficial to most of the public, and actually they, of course, are going to add to the deficit. And the reason I'm showing you these things here is to show you some of the reasons why we are going to have higher and higher deficit going forward. We need money for all these things that are described here. The child tax credit is being raised from 6,000 to 8,000, and Affordable Care Act premium now is going to be expanded, so more people will qualify for zero or low premiums for their health insurance. Then also earned income tax credit for childless workers is going to be higher. For childless workers over 65 is going to be available. And then, of course, renewable energy tax credits. All of these are noble causes, noble reasons. I don't believe that most people will disagree that we should not offer those benefits to society. People who need them, they should deserve, they should be given. But on the other hand, there's a tax impact, and some people don't like it. Some people say, if my money is going to be really used for these purposes, I don't mind paying a little bit more. But then some people will end up paying a lot more, and that's where the big rub comes in. And we want to make sure that there are ways for you to reduce the impact of taxes. So paying taxes in itself is not bad. Paying too much in taxes is where law says, hey, if there are ways, by all means, legally take advantage of those. So reiterating the same thing again about in a different way to show you that Social Security tax now, which used to stop at $142,000, $142,800, is going forward. If the Biden proposal passes, then you're going to pay the Social Security tax on all income over $400,000. Now, the strategies that can be considered in lowering the taxes, again, we do not know if these things will fly or not, because they are trying to close all kind of loopholes. Under current laws, you know that if you have an S corporation, and let's suppose you brought an income of $500,000 to S corporation, and you say, if I take that all of that money as my W-2 income, I'm going to be paying income taxes on 500,000. Well, we all had to pay, but then you had to also pay Medicare tax and Social Security tax on the full 500,000. So the strategy has been, okay, what I'm going to do is I'll take $400,000 in the form of dividends and $100,000 as reasonable wage as my income. So I'll pay my regular income taxes, regular income taxes, including Medicare and Social Security tax on the W-2 income. And what I take as dividend, I don't have to pay Social Security tax and Medicare tax on that. So that strategy may survive or may not survive. We do not know that yet. Okay. And again, reorganization of a C corporation, that may be a consideration. Again, that'll depend on how the tax rules pan out. Okay. Then, of course, there should be some other forms of compensation that should be considered, and those are higher end at advanced level. If you have a corporation and there's a lot of profit coming in, I'll be happy to meet with you and talk to you, or actually on the phone on an individual basis, and show you what those methods that may be applicable to you. So now we have the Secure Act. As you remember, that the word Secure Act has been thrown around a lot, and as you know, that Secure Act has led to the consideration of higher taxes, and they're going to be hard taxes to pay by your heirs also. The changes that took place, as you know, under Secure Act was number one, that the RMD, the required minimum distribution, used to be that you had to take the required minimum distribution by age 70 and a half. And it was changed to age 72. And under the Biden proposal, it's also being considered that we should raise the required minimum distribution for people who are retired to age 75. So you should not be forced to take the percentage of your pension plan and deplete it at earlier ages. Maybe you don't need it at age 71, 72, 73. So Congress says, or at least Mr. Biden's proposal says, that you keep the money inside the pension plan and start the required minimum distribution at age 75. And also, as you recall, one of the very powerful tool of planning was stretch IRAs. So if you had a significant amount of IRA a significant amount in your IRA, where you said, I don't think I'll ever be able to use all that money. So you had 3 million, 5 million, $8 million, whatever amount you had. So you could actually pass it on to your children and let it go on for the rest of their lives. So your IRA, your pension plan, then would become the pension plan for your children. And I used to actually explain to my clients that that's a safety net. That's a second pension plan that your children will have on top of, actually, I should not say on top of, actually below their own pension plan that they create. So this is the pension plan that you're passing to your children would be really a safety net. If everything else falls apart, this pension plan is always going to be there. And so that strategy is being taken away. And actually, that has already been taken away. That strategy does not even exist anymore. Okay? And now you may say, okay, you can pass it on to let's suppose you have an IRA, you gave it to your children at your death. Do they have to cash it all out at one time? No, they will have up to 10 years to use the money. All right. Now, RMD may be increased to age 75, and some of the benefits that have been added is people who have not put up enough money in the pension plans, they'll be given option to put in a lot more. We call that catch-up the catch-up clause. So that will allow them to put a very significant amount if they are able to prior to age 60. Okay, or actually at age 60 or later. Okay, so let's suppose somebody was working very, very hard and his income really went up significantly only, so let's say in mid 50s, but he does not have that much money to put away in pension plan yet. But because his income went up significantly in later years in life, so the catch-up clause will allow him to put a lot more at age 60, 61, 62, and so on. And also the charitable contributions that you were able to make from your retirement plan directly to charity, yes, you can do that. And you can give away as much as $130,000 a year to charity. Okay? And then another feature that has been added is qualified student loan payment that an employer can make to the student's loan, the employee's loans, and not had to be declared as income to the student. So we know that capital gains are going from 20% to 39.6%. And we need to talk about some strategy at some future webinar, and I'll cover that too. Now, before we run out of time, I want to talk about a very powerful strategy in estate planning, and it's a very high time today for you to start working on this strategy almost immediately. And that's assuming, of course, Congress does not change the laws retroactive. Under current laws, you can pass, as I mentioned earlier, you can pass on up to $11.8 million to your children. Again, please forgive me if I'm talking about in these large numbers for people who are perhaps starting out in life today. And I'll come back to your situation too, but few people who are right now on the webinar have significant assets, I know that, and very, very significant assets. So the next 3 or 4 slides will really apply to them. And if you want to discuss those people who are in this situation, if you want to talk to me about this situation on a personal basis, you'll be welcome to call me, and I'll give you more ideas and suggestions. And also, if need be, I'll connect you with some of the best attorneys who specialize in these things. And actually, some of the attorneys that you saw earlier in the picture, they too are going to be my advisors in guiding you along. In any case, what is spousal limited access trust? As you know, you can give $11.8 million. Let's suppose you have assets of worth 25 or $30 million. And you know, under current laws, you can give away up to $24 million to your children. And you don't want to, generally what happens is you do not give all the money outright. You put that money into something called irrevocable trust or dynasty trust. Once you put the money in that dynasty trust, now it's out of your control. You have no say in those matters, gone from your estate. A lot of people are hesitant to do that because they say, look, I don't know. I may need the money tomorrow. I don't want to give it away. So good planning says you should put it away, but deep inside the person says, I don't want to part with the money yet. So SLAT actually accomplishes both goals. So what you do is you create a special irrevocable trust for the benefit of your spouse and your children. So now if your spouse is a beneficiary of the trust, guess what? Indirectly, you are benefiting from that. So you did not really give it away. And guess what? You, you can actually have a similar, your spouse can have similar trust where you are the beneficiary. So let's look at the next slide. First, let's reiterate what I just mentioned to you in a picturesque way. So I'm going to draw I've drawn some pictures to show you. So in this example, I used the figure of a grantor is only giving only $5.12 million. Okay, could be a lot more, as I said, up to $11.8 million. So in this case, the grantor being husband or wife, so the grantor is the one who gives it away. So he puts in $5.12 million in spousal lifetime access trust, and his spouse and children and grandchildren are the beneficiaries. So if a spouse is the beneficiary, it means indirectly the grantor, the husband also is going to be able to use the same funds. So that's what's different for spousal limited access trust compared to the standard irrevocable trust. In a standard irrevocable trust, it's only children and grandchildren are the beneficiaries. And of course, once you have money passed on to your children, nobody likes to ask the child, hey, can I get $100,000 a year from you to live a better life? Because I don't have any money to live on now. But if your spouse is beneficiary, hey, that situation does not apply. That's why SLAT makes a lot more sense in estate planning than a pure old kind of irrevocable trust. So here's how it works. If both have spouses set up a cross trust with beneficiary, each of them being beneficiary. And of course, the terms of the trust cannot be the same. If they are the same, then they're reciprocal trust, and IRS will negate that. So the one trust could have more limited powers assigned to the trustee and the beneficiary than the other trust. And also, you could have a third party as trustees. For example, a trust company on one of the trusts and not for the other trust. So in any case, so here's the example shown that husband creates a trust for the beneficiary for the benefit of his wife. We'll call we actually the proper term which we use in our estate planning is really it's a dynasty trust, and the sub definition of that trust is SLAT. Spousal. But dynasty trust comes in many different forms. So in this case, it's a SLAT trust. So a SLAT trust, husband creates trust for the benefit of his wife and children, and similarly, wife creates a dynasty trust for the benefit of her husband and children. And let's see. So now we move to the next one. So this is again to reinforce on you that we are actually going to have higher taxes for sure in coming years because our GDP the debt to GDP ratio has increased very significantly. So here's what President Biden had to say, that every major economist thinks that we should be investing in deficit spending in order to generate economic growth. So that's the justification for the new $1.9 trillion that's being asked for. And makes sense. Whether I agree with it or not, well, some people agree with it, some people don't. In my view is, okay, if it indeed is going to help the country and raise revenue, by all means, go for it. What is $1.9 trillion compared to what all we have already accumulated? Again, that's my personal view, by the way. So now other thing that you need to keep in mind that currently we are in a much lower tax bracket than we were before 2017 when Tax Cuts and Jobs Act was enacted under President Trump. That will be expiring 2025. So that gives you a great opportunity right now to convert your IRA to Roth as much as you can. Because if you wait till 2025, you are going to be paying a much higher rate. So we call conversion of IRA to Roth in brackets. And again, there's a deep analysis that goes into it and should be done every year. And do not miss out the opportunity from today till 2025. Convert as much into Roth IRA as you can, and you will be able to do so at a much lower tax rate than will be after 2025. So question number two, what can you do to help yourself? Well, I just mentioned to you that one of the things you can do is convert your IRA to Roth, and the other is set up a SLAT. As much as you may not want to part of the money yet, in a regular standard, regular dynasty trust, talk to your attorneys and advisors about SLAT. And and if again, my invitation to you is open, call me up after we have finished the webinar. I'll be sending you an email with my contact information, and this we can. I see that a few questions have popped in from chat, and people are asking me some personal questions, but I do not want to be. Firstly, I do not want to take time from the webinar. Besides your personal situation, I do not want to be talking about those on the webinar. Okay. So now with limited time left, I'll try to rush through the slides and cover the main points anyway. And one of the things that you need to do is create a tax diversification in your portfolio. Right now, your assets are in the form of taxable income, tax deferred income, and tax-free income. You have to have all three types of income. And I do not know whether many of you really know how much after-tax income you're going to have at retirement. So I'm going to actually at this point I'm going to ask a question: how many of you really know how much income you will have after-tax income you'll have? Remember, you may be saying, yeah, well, I'll have $200,000, $150,000 from my pension plan. Okay, you're going to have that much, but how much you're going to have after tax? Do you have? Again, consider tax rates of reasonable tax rates in the same tax bracket that you were in last year. Use that and give me the number. Here's a poll. I'm going to start, and let's see. Go ahead, tell me. Let's see. I am looking at that. No, that question is longer, so we'll skip that. I don't want to take time out and just continue. There'll be more questions I'll ask you, but I want to reach near the end of the webinar right now. All right. And so now one of the things we can offer you at my office is analysis of tax diversification of your assets, of your income, actually income and assets. So if anyone would like to have the review of tax diversification of your assets, how much after-tax income you will have, how much pre-tax income you will have, my staff will be happy to help you on that. All right, and talking about the Roth IRA, at one point I had mentioned to you that you should convert your money to an IRA to Roth as much as possible. And I had also mentioned, do you really know how much debt you're carrying? I have clients who tell me, everything's paid off in my life. Home is paid off, everything's paid off. I don't owe anything to anyone. They forget that's not the case. You are carrying debt to IRS in your 401k and IRAs. Let's suppose you are a young man, you look at your 401k and it's about $1 million. You think it's your money. No, no, no. Almost half of that is IRS money. They'll come calling on you at some day in the future. And those who have retired, if you have, let's say, 5, 6, 8, 7, 8, $10 million in your IRA or pension plan, half of that it belongs to IRS. So you do have a debt to IRS, and the best thing would be for you to pay off the debt now and accumulate tax-free after that. We call we call conversion to Roth as pay once your taxes and never have to pay again. And regular IRA, you're going to be paying tax forever. Every time you take money out from IRA, you pay tax. So right now, the tax rates are high, but nothing compared to what they will be. So consider that very seriously, and we'll be happy in my office to do a Roth conversion analysis for you. Okay, so again, it is a snapshot of where the taxes are heading, and I had mentioned to you that that you're going to be currently the 37% tax bracket hits at income level of 622,000. But going forward, you may be paying almost 40% just at $470,000 of income. That's a big, big jump. Okay. Now, this is the best area where you see over here at income brackets of 180,000 to 326,000. That's the best region for people to take advantage of their if you're currently contributing to IRA and 401ks, etc., or if you do not have a very large amount of income, that's the region that you need to consider for conversion to Roth of your 401k or IRA. And again, we'll be happy to do an analysis for you. All right, and here's an example for Dave and Sarah. They have income of $170,000. In 2017, the tax bracket, this is before Mr. Trump signed the new tax law, the tax bracket, they would have been in 28% tax bracket. After the new tax bill was passed, the tax rates came down to 22%. And we expect they'll go back to 28% in 2026. So now is the best time to convert. And by the way, this is if we go only to 28%, we do not know how high the rates may go. Who knows that instead of 28%, they may go to 30 or 32 or 34%. I got one chat from somebody says, no, they may be going to as much as 40 or 50%. Yep, that could happen too. But I hope it does not happen to people in the middle income. All right. And so we're going to skip this because this requires an analysis of IRA to Roth. And I see the clock is running out. So I'll be happy to do that analysis for you individually on a one-by-one basis. Give me a call and we'll do a Zoom call, or we'll cover this at a future webinar. Okay. So bottom line, convert your assets to tax-free accounts as much as possible. And you cannot have better plan than Roth IRA under current laws. All right. So this again talking about conversion, the benefits of that. Okay. All right. And so the main goal for everyone should really be to enjoy a financial independence by the time you retire. And you should have a written retirement income plan. It's very, very important. Without a retirement income plan, it's like going from here to New York by car and not knowing what roads you're going to take. So you need to have a written plan for the peace of mind. And people who are in a significantly higher income, perhaps not a concern because they'll always have more income coming in than outgoing. Still, it's a good idea for everyone to have a written retirement income plan. And if you do not have that, we'll be happy to. We have very sophisticated software in our office. We can actually create an asset map. I want to tell you what the asset map shows. Today, you have your assets in many, many different blocks. You have some money in this investment, some money in that investment, some money in that investment. Some are tax free, some are pre tax. And you may have 8 or 10 or 15 accounts. But altogether, if I ask how much you have in tax free, how much you in a pre tax account, chances are most of you cannot answer that. So our asset map actually puts all your assets in one page picture form and shows you how much of tax-free income you can expect at retirement and how much of pre-tax income you can expect. So overall, you will have a very nice snapshot in one page, and that can be updated every year or 2 years until your retirement. So you should have what I'm offering to you is a written retirement income plan and also a snapshot of your current assets. And let's see. Um, okay, and let's see. So now we go to the, the definition of a financial plan. What is really a financial plan? We talk about taxes, we talk about Roth, we talk about all that. You know, standalone, they mean nothing on their own. All of that had to be part of an integrated pension plan, an integrated financial plan that involves taxes, healthcare. What good is it your financial plan if healthcare in your old age is going to wipe out your assets because perhaps you need long-term care? I've seen long-term care expenses of as much as $20,000 a month when you need a private nurse. I had a situation of two brothers who wanted to provide the best care for their 98-year-old mother who had lived good life until age 95. Then she went downhill and they wanted to provide the best care. And they had, even though she was in a nursing facility, I shouldn't say nursing facility, but old folks home where a lot of retired people live, but they want to have 24-hour private nurse on duty, and they were spending about $22,000 a month. That depleted most of the assets they were going to inherit over a period. She lived about 4 years after that. So healthcare is very important, and then you want to make sure your investment growth is occurring in the proper ways and at a reasonable way, and also is protected from future crashes that may be coming. If most of your money is in stocks, well, that's maybe good for now, but may not be the most prudent thing to do. So comprehensive financial plan is not only taxes or estate taxes, it's everything all included together. And that's the kind of planning we do at our office. And anytime you have some questions, need advice, I welcome you to give me a call, and I'll send you my contact information shortly within either this evening or tomorrow. All right, so we'll give you those who are interested, we'll give you a written retirement income plan. Like I said, we have very sophisticated software, one of the best software programs in the country, and we'll use that. And it'll also give you an idea when your paychecks will start at retirement and how they'll grow, where they'll come from, what sources they'll come from, and how long they will last, and will the income be enough for the rest of your life, and will it grow over your lifetime? We can design all the scenarios. Okay, so get a written retirement income plan, whether from us or from your current advisor if he has those capabilities. Now, here's what Will Rogers said. The difference between death and taxes, death doesn't get worse every time Congress meets, but our taxes do get worse. All right, so that's where we stand. And once again, mine is Paul Kalra, Signature America Wealth Management. And I see that's exactly 1 hour. Go ahead, post any questions you have. I'll be happy to answer those if we have time. Otherwise, I'll send the answers to you by email separately. Okay. So any questions? I see that question actually are popping up. Yeah, go ahead, continue to add those questions. And thank you again for spending your hour with me. I hope I have given you useful information that you can take with you tomorrow to your advisors. And again, my doors are open to you for advice and help.